Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: from One News on the 9th of June, another big bank cuts home loan interest rates. Second topic from RNZ on the 9th of June, it'd be foolish to be relying on a council valuation, property experts. Topic number 3, good returns on the 11th of June. Excessive security agreements by banks need investigating, lobby group. And from oneroof.co.nz on the 11th of June, Tony Alexander, who'll blink first on unrealistic asking prices. Last but not least for this week in review, from RNZ on the 12th of June, the suburbs where house prices are picking up. So first up this week from One News on the 9th of June, another big bank cuts home loan interest rates. Kiwibank has reduced several of its home loan interest rates, with the 1-year special fixed rate now at 4.89%, the 2-year at 4.95%, and both the 3-month and 6-month rates at 5.29%. Term deposit rates have also been trimmed by 10 to 15 basis points. These changes follow a broader trend influenced by the decline in the OCR, which has dropped from 5.5% down to 3.25%. However, a cautious tone in the latest Reserve Bank update, where one member of the Monetary Policy Committee opposed the cut, has cast doubt on whether further OCR reductions are likely in the short term. While swap rates briefly rose in response, they have since begun to ease again. David Cunningham, CEO of mortgage advisory firm Squirrel, noted that retail interest rate changes are now largely driven by competition among banks. He observed that unless wholesale rates fall decisively below 3%, any further reductions in fixed mortgage rates could be minor. He suggested that 1 or 2-year rates could dip to around 4.75%, but reaching 4.5% would likely require another OCR cut within the next 3 to 6 months. Other major banks have also moved to lower rates. Last week, ANZ dropped its 18-month fixed special by 10 basis points down to 4.89% and cut its 6-month rate by 20 basis points down to 5.29%. ASB followed with its 7th rate reduction this year, trimming several fixed mortgage rates. Its 6-month rate fell to 5.45%, 1 year down to 4.95%, 18 months to 4.89%, 2 year to 4.95%, and 3 years to 5.15%. Second topic for this week in review from RNZ on the 9th of June, it'd be foolish to be relying on a council valuation, property experts chip in. Auckland Council's new property valuations, or CVs, have shown a 9% average decrease across 630,000 homes, alongside an average rates increase of 5.8%. While the drop has unsettled many, property experts are urging homeowners to stay calm, stressing that CVs are primarily used for setting rates, not for determining market value. Waiheke Island homeowner Amanda Wright saw her property valuation drop by $50,000 to $1.1 million. Although she expected a larger decrease and found some relief, she admitted the drop was still unsettling and caused her to worry about future value recovery. Some property owners experienced even steeper valuation declines, particularly compared to 2021 levels when prices were at a peak. Despite this, the Homeowners and Buyers Association of New Zealand reassured residents that CVs are not indicators of true market value. President John Gray noted that his own home's CV had fallen by $250,000, a change he welcomed as it could reduce his share of the rates burden. From an investor perspective, the Property Investors Federation said most landlords and long-term investors wouldn't be alarmed. Spokesperson Matt Ball explained that unless someone was selling immediately, CVs had little impact. He emphasised that seasoned investors expect to ride out several property cycles. Still, for homeowners like Wright, the lower valuation has introduced hesitation. She admitted it made her question whether she'd overcapitalised and caused her to reconsider planned renovations. But Gray cautioned against letting CVs influence such decisions, saying they're not reliable indicators of a property's actual worth. Banks, he noted, rely on independent registered valuations when assessing loan apps. Ball agreed that the market, not the council, ultimately determines a property's value. While CVs might shape a buyer's perception initially, he said real market prices are set by demand and negotiation, which often move independently of official valuations. My advice on this is don't freak out if your council rates or your rateable value has dropped, unless you are planning on selling in the next little short term. For anyone else who's out there looking at purchasing, this is a fantastic opportunity to negotiate hard because, as you've just seen in this article, lots of people have the assumption that rateable value has got something to do with market value. So there will be some homeowners out there that'll be disappointed that their house's percent value might be decreased, but they still could be motivated to sell. So this is a pretty good negotiation point, in my opinion. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and a financial advisor. And for all of our free events, they're available live and online. So check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book in a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. Topic number 3 from Good Returns on the 11th of June, excessive security agreements by banks need investigating. Lobby Group. The Commerce Commission may soon examine banks' use of General Security Agreements, or GSAs, following concerns raised by the Banking Reform Coalition. According to the coalition's leader, Kent Dustin, these agreements often extend far beyond the initial loan, encompassing assets not directly related to the borrowing. This makes it difficult for borrowers to seek alternative lenders as their assets are already tied up. Dustin noted that New Zealand once had a healthy second mortgage market where borrowers could secure a primary mortgage from one source, such as the government, and top it up with a second mortgage elsewhere. However, since the global financial crisis, banks have become more risk-averse, favouring first mortgages and viewing second mortgages as administratively burdensome and less profitable. The coalition questions whether the aggressive use of GSAs has contributed to the disappearance of second mortgage options, potentially stifling competition. In many cases, Dustin said, the security bank's demand exceeds both the loan amount and the total interest owed, raising concerns about fairness and market dominance. The group believes this overreach may be anti-competitive. Although it acknowledges that holding such an opinion doesn't prove wrongdoing, it is exploring whether there are grounds for a formal complaint to the Commission. Dustin pointed to the Commission's past action against supermarket chains using restrictive land covenants as a successful example of addressing anti-competitive behaviour. The Coalition is seeking similar regulatory scrutiny in banking. Additionally, the Coalition has spoken with the FMA, the Financial Markets Authority, about full recourse mortgages in New Zealand. Unlike in the United States, where mortgages are typically secured only against the property, in New Zealand, borrowers are also personally liable. Dustin argued that the bank's united stance on this issue may reflect an abuse of market power and an unnecessary burden on borrowers compared to international standards. Last year, the Commerce Commission identified New Zealand's major banks as operating within an oligopoly, noting their higher than expected profitability. However, it emphasised that making large profits isn't illegal under current legislation. While the coalition originally called for an investigation into the bank's record $7.22 billion profits during a recession, claiming it disadvantaged smaller players, the Commission clarified that it lacks the legal basis to act on profits alone. It encouraged the coalition to pursue other concerns through formal channels if they might warrant regulatory intervention. The coalition has since submitted specific concerns and is awaiting a response from the Commission in the coming weeks. Fourth topic for this week in review from oneroof.co.nz on the 11th of June, Tony Alexander, who'll blink first on unrealistic asking prices. This analysis was provided by independent economist Tony Alexander. Despite mortgage rates dropping below 5%, that's down from over 7%, New Zealand's housing market has barely moved in recent months, with average monthly price gains sitting at just 0.1%. Several factors are contributing to the stagnation, the most significant being job insecurity. A monthly survey of real estate agents conducted with New Zealand Home Loans found that concern about income stability has surged among buyers. While only 14% of agents reported such concerns early in 2024, that figure spiked to 56% in June and currently sits at 51%. This hesitation is not only affecting buyer confidence, but also influencing how banks assess mortgage applications. Lenders are applying more caution, limiting credit access, even for applicants without immediate concerns about their jobs. Many property investors are offloading assets due to rising costs, especially insurance, rates, and maintenance, or to fund unexpectedly expensive retirements. Although some investors remain active in the market, an increasing number are choosing to sell rather than buy. At the same time, supply is abundant. Property listings have reached their highest levels since 2015, with around 33,000 homes on the market. That's more than double the number seen in mid-2021. Developers struggling to sell new-build townhouses at desired price points have instead opted to rent them, further swelling housing stock and giving tenants more choice. This has made it harder for landlords to secure quality tenants. Buyer behaviour reflects this favourable trend. The urgency that once defined the housing boom has faded, fear of missing out, or FOMO, has largely gone. Buyers are in a strong negotiating position but remain cautious. Many believe prices could still fall and are hesitant to commit. This is reflected in rising levels of FOOP, or fear of overpaying, which 39% of surveyed agents now observe. That's the highest since June last year. Vendors, however, have been slow to adjust their expectations. Many still price properties as though the peak conditions of 2021 remain, creating a standoff between buyers and sellers. Until sellers begin to accept current market conditions, prices are unlikely to rise significantly. A shift in employment confidence could change this. If job security improves, sellers may hold firm on pricing, anticipating renewed demand. But with the unemployment rate at 5.1% and expected to increase, along with businesses turning to AI-driven cost cutting, the employment outlook remains subdued. For now, buyers are waiting, and sellers may be the ones who have to blink first. My opinion on this is that it's absolutely true that the majority of the reason that buyers are sitting on the sidelines at the moment is because of job security. However, there are really good opportunities out there for people who are in the market to purchase. It's a pretty balanced market at the moment, lots of listings, not that much competition from other buyers. And in my opinion, as soon as the economy starts to show stronger signs of strength, that's going to bring more confidence into the market. And that's when more buyers will step in and prices will start picking up because of that supply and demand balance. Fifth topic for this week in review from RNZ on the 12th of June, the suburbs where house prices are picking up. New data from Cotality, previously called CoreLogic, reveals that house prices are beginning to rise, particularly in more affordable suburbs, but townhouse values are showing slower and more inconsistent growth. Over the past 3 months, standalone house prices either remained stable or increased in 62% of suburbs. Notably, 78 suburbs recorded house value growth of at least 5%, including Elderslie and Waitaki, Ngātaki, Far North, and Evansdale and Dunedin. These areas shared a common trait, median values below $650,000. In major centres, moderate gains were also observed. Kelburn and Wellington rose 4.1%, Templeview and Hamilton was up 3%, Little River near Christchurch increased by 3.1%, and Bethells Beach in Auckland climbed 3%. By contrast, only 54% of suburbs saw townhouse and flat values hold steady or increase, and just 16% had growth that exceeded 2%. Some of the better performing suburbs included Waikouaiti and Dunedin, up 6.8%, Chedworth and Hamilton up 4.8%, Onetangi and Auckland up 4.2%, and Eastbourne and Wellington up 3.9%. However, 42 suburbs recorded townhouse value declines of 3% or more. Totality property economist Calvin Davidson noted that the strongest growth appeared to be in the more affordable and often rural areas, such as Clutha, Dunedin, and parts of the West Coast. He attributed this in part to increased farm incomes and more money circulating in small towns, boosting buyer activity. Davidson also highlighted the impact of supply on townhouse prices. Areas like Auckland, Christchurch, and Wellington saw a surge in townhouse construction, which may now be dampening price increases in some areas. While the pipeline of new developments has slowed, the lingering supply of recently built homes is still influencing the market. Despite slower growth, townhouse values have largely held up. Davidson said this suggests that there is still buyer interest, especially with incentives available for new builds under lending rules, such as exemptions from certain debt-to-income and loan-to-value restrictions. He also pointed to shifting preferences, with more people now open to townhouses either by choice or necessity. However, overall housing market growth remains subdued. A high number of listings and labour market uncertainty are expected to limit momentum in the short term. Davidson said that although the downturn may be over, the recovery has yet to gain real traction. Totality's data also highlighted improved affordability in some regions. In Wairoa, servicing an 80% mortgage on a median-priced home now requires 30% of the median household income compared to a historical average of 40%. If you've looked at recent Real Estate Institute of New Zealand reports, particularly the House Price Index, you will see that housing affordability has improved considerably. And even in areas where rental demand has softened, the prices have softened in those areas as well. So it's actually increased the rental returns in those areas. If you've been waiting for the right time to invest in property, this could be it. With prices stabilising, buyer competition low, and stronger growth showing up in some of the more affordable suburbs, savvy investors are already taking advantage of the current conditions, and we're certainly seeing an increase in the number of property investors entering the market at the moment. Join us at one of our free events called How to Succeed with Property Investing. These events are available online, so you can gain valuable insights and strategies tailored to today's market conditions. Whether you're an experienced investor or just getting started, this free session will equip you with the key tools and insights to make confident, informed decisions. Don't miss out, register today, and take the next step towards achieving your financial success. In our free events, I'll also tell you more about how we help our clients to achieve their investing goals. So if you're interested in finding out more about what we do, go to propertyapprentice.co.nz today and register for a free event. If you've already been to one and you'd like to know more about how we can help you on your journey, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. That's propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.